Hey, welcome back to the Your Financial EKG YouTube channel. My name is Drew Blackston. I'm a certified retirement counselor, investment advisor representative, and I am your virtual financial advisor, getting you to retirement, getting you through retirement, and protecting your ability to stay in retirement. Now, I want to talk about 3 ways that you can lower your tax bill come the end of the year, because at the end of the year everyone's looking for ways that they can lower their taxes. And so I want to give you 3 easy ways that you can lower your taxes. The first 2 are for anyone, but the third step is specific for those who are in retirement. So step number 1, the easiest way you can lower your taxes is you can sell losing stocks. All right, so what do I mean by that? If you have a non-qualified account, like a trust account, maybe an individual account, or a joint account, you can actually sell your stocks, your mutual funds, or your ETFs at a loss, and that loss gets to go on your tax return as a capital loss. Now, you're allowed to write off $3,000 of capital loss every year. Now, let's say you have some capital gains. Let's say that you owned a stock and it went up big and you sold it and you have a $20,000 gain. Well, let's say you have another stock that has a $20,000 loss. Well, if you sell the gain and you sell the loss, you actually offset the 2, and now you don't pay any tax on the capital gain. So that's a way that you can actually lower your tax bill without having to jump through hoops or anything like that. Now, another way to do a double benefit on this sell your stock or sell your losers for a tax write-off is you can actually sell your stock for a loss and then take the cash from the sale and give it to charity. Now, if you itemize your deductions, you actually get a capital loss write-off, right, for the stock, and you get a charitable donation for the money that you gave to charity. It is a double benefit, all right? Now, the second way you can lower your taxes is you can actually give away shares of your winners. So let's say give away your winners. Now, what do I mean by that? What I mean is, let's say you own Apple stock and you bought it at, I don't know, $50 a share, and it's trading at $150, and you've got a $30,000 gain. And let's say that there's a special charity that you really want to support. Well, you can actually give away portions of your stock of that winner to charity, and now what you're doing is you're actually allowed to use that as a charitable deduction. So whatever you give to the charity, the full market value, let's say you give $10,000 worth of Apple stock, you get a $10,000 charitable deduction. Again, it only works if you itemize. And again, step number 2 is a double tax saver, because when you give those stocks to the charity at a high, you avoid paying capital gains tax on that. So instead of selling the stock, paying the capital gain, then giving the cash to the charity, now you've given the stock to the charity, you don't have to pay the capital gains, and you get a charitable deduction. Isn't that amazing? So think about it this way. If you had $10,000 in your checking account and you were going to give that to a charity, look at your brokerage account and say, can I give any of these winners away and get the charitable deduction for that? So now you don't have to give away the $10,000 in your checking, you're giving away the stocks, you're saving on the capital gains, and then you can use the money in your checking, put it into the market, and buy some shares of stock at a lower price. You know, that way you're not having to give away money. You're getting a tax saving and getting to invest more money. Isn't that great? All right, the third way that you can save money. Now, this is especially important for retirees. So the third way that you can lower your tax bill, and this is in retirement, is you can use your IRA to make charitable donations, okay? This is called a qualified charitable deduction, okay? If you're over the age of 70 and a half, the IRS allows you to take money out of your IRA, give it directly to a charity. So it goes from the IRA to the charity directly, and you actually get it's not even taxable to you. It just goes to the charity. It's tax-free. Now, At the age of 72, you have to take a required minimum distribution. So this really works better for those who are over the age of 72. So let me give you an easy example. Let's say that your required minimum distribution for the year is $20,000. But let's say every year you give $5,000 to your local church. Well, instead of taking the $20,000 out of your IRA and then giving the $5,000 to your church, do this. Take the $5,000 out of your IRA, give it directly to your church from your IRA, and then take $15,000 out of your IRA. Because the money that you give to the charity out of your IRA does count towards your required minimum distribution, but it's not taxed. Isn't that great? So the third way that you can lower your taxes, especially in retirement, is give what they call qualified charitable distributions. Okay, so let's go over this again. Step number 1, sell your losing stocks. Step number 2, give away your winners. And step number 3, if you're in retirement, do a qualified charitable distribution. Remember, this also qualifies as your RMD, another easy way to lower your tax bill. Okay, now listen, thank you so much for watching. Remember this, taxes change on a yearly basis. If you're watching this in the year 2023, 24, 25, whenever, taxes change on a yearly basis. Make sure you talk to your CPA, your financial advisor, or contact me to make sure that you're making the appropriate tax decisions for you and your family. And listen, if this is your first time watching the Your Financial EKG channel, make sure you hit the subscribe button below. Smash the like button if you enjoy this content, and leave your questions and your comments below. I really appreciate everyone watching. Thank you so much. Have a great rest of your day. God bless. Bye-bye.